Hey, this is attorney Elizabeth Potts-Weinstein. Today we're going to be talking about the top 5 mistakes people make when setting up their LLC. And specifically, I'm going to be talking about small businesses where there's one owner or just a few owners and the mistakes they make when setting up their limited liability company. So for those of you who don't know, a limited liability company is just a type of legal form of a business. You could also have a corporation, a partnership, a sole proprietorship, but today we're talking about LLCs. And LLCs are great because they're not quite as complicated to set up or run as a corporation, but they have a lot of the benefits, including limited liability. But there are a number of mistakes people make, and the mistakes can mean that you lose the limited liability. You lose the liability protection of the LLC. When you put the business into the LLC, it protects your personal assets from the business getting sued or not being able to pay its debts or going bankrupt or whatever. And you want to make sure that is preserved. And there's a number of mistakes people can make that can jeopardize having that protection. So let's go ahead and get into it. Number 1 is not having a written operating agreement. So an operating agreement is kind of like a partnership agreement between the owners or members of the LLC on how the LLC is going to work. Now, in most states, you're not legally required to have one. However, I recommend that you always have one, even if it's just one owner. And I get that if you're just one owner, it is awkward and weird because you're signing a contract with yourself. However, it's a way to establish the paper trail of your business and another way to show that your business is legit. And then you also have an opportunity to set ground rules for your business. So this is not as big a deal if it's just one owner. But if you have multiple owners, there's a possibility that someday you're not going to agree. There's going to be a misunderstanding about how things are supposed to be done. And so by setting things up in the beginning, that can really help reduce the likelihood of those misunderstandings based on how people are voting, how much hours each week someone is going to be working on the business, what are the different roles and responsibilities, what happens if someone wants to get out. Maybe there's 3 or 4 different owners and you're all going to be working on the business, but one person can't work on the business because they're sick or they just don't want to do it anymore. What happens? Can they sell their shares to a stranger? Are you supposed to buy them back? That's a big, huge mess if you don't deal with it on the front end. Another associated kind of problem that I'm going to put this as 1A is not signing the operating agreement. It is very common for people to get an operating agreement that they get from the company they hired or the lawyer they hired to form the LLC, and they don't read it and they don't sign it. And then it's a waste. It doesn't exist. You didn't execute this agreement. It might as well not have happened. So you need to actually sign the thing. Number 2 common problem is not doing the required annual filings. In every state, I think in every state, there is going to be some annual or every other year filing you have to do with the state. I'm not talking about taxes. I'm talking about just a filing. In California, it's a statement of information. In other states, it's called an annual report. It's typically some document you file that just updates like your address and stuff like that. I mean, it is not a big deal. It's a relatively nominal fee. In California, I think it's $20 right now. In some states, it's like $100, but this isn't thousands and thousands of dollars, and this is something separate than your taxes. But every year, or in some cases every other year, you have to file something with the state, the same place that you filed your original documents with the LLC. Very common for people to not even realize they have to do this. They don't file it, and then their LLC eventually gets administratively dissolved. In other words, it no longer exists, and you don't even know that it no longer exists, and you lose your liability, and that sucks and is terrible and a waste of your money. Now, sometimes you can fix it by paying a whole bunch of money and like all kinds of fines and penalties to fix it. And sometimes you actually can't, you got to start over again. Depends on how long it's been. And also then sometimes the name of your business is up for grabs in the interim. I mean, this is a horrible mess. You want to make sure that you put that on your calendar, that every year or whatever the requirement is in your state, you do that annual filing. Number 3 is mixing up money. Is mixing or commingling your personal money with the business's money and just being too casual about it. This happens the most with one owner businesses. So, for example, I have an LLC. I also have a corporation, but I have an LLC, and let's say my LLC makes money and it has $1,000 in the checking account. Well, You might think, well, I could just use that $1,000 to pay for my groceries or to pay for whatever I need in my life. No. You have to distribute that $1,000 of profit, I'm assuming this is profit, to the owner, and then the owner puts it in their checking account, and then they can spend it on their groceries or whatever. Very common, especially in one-owner businesses or closely held businesses where it's just a family or something, to not go through this formality of actually paying themselves because they think, well, it's just my money. It's not your money, it's the LLC's money. You have to pay yourself. Now, how you do that does depend upon the tax status of your LLC. If it's being taxed as a sole proprietorship, a partnership, a corporation, S Corp, C Corp, you're gonna do it a little bit differently, but generally you need a paper trail of that. So it could be writing a check, it could be running payroll if it's an S Corp or a C Corp. It could be doing a transfer of money and you put in a memo in the little transfer when you fill it out, what this is for, that's for distribution, and you put it in your bookkeeping. So you wanna make sure there's a paper trail. It doesn't have to be a little piece of paper, it can be electronic paper trail, but a written record of the fact that that was a distribution of profits to you as the owner. Number 4 is not having record keeping or having way too minimal record keeping. Now, record keeping for a really small business that's really simple doesn't have to be super complicated. You could literally have your record keeping be on paper. You could have a document where you just write everything down. That is fine. You could have a spreadsheet where you keep all of your records, but you need to have something. Okay, you need to have something where you're writing down your income as the money comes in, you're writing down the expenses as they go out, you're keeping a record of all those expenses in case you got audited. You have a paper trail of all that. And then anything big that happens in the business, you also want a paper trail of. So let's say you decide to get a small business loan for your business. You need a written record that the owners agreed to get this loan. That sounds weird if it's just you, or if it's just you and your business partner and you just talked about it, but you want a written record of that so you can show the bank, okay? You need a paper trail of any kind of non-ordinary decisions in your business. It's just like minutes of a meeting, you just have some declarations, however you want to do it. There's different ways you can do it in a formal way, but you need to have a written record of that agreement. You want everyone to sign it. It can be electronically signed, that's totally fine too. And then of course, as I say in many videos, you want contracts with everybody, with all the different relationships the LLC has. You need to have a written contract. How that looks can be different. It can be literally paper and you sign it with a pen. It can also be an electronic contract. It can be terms and conditions on a website. There's a lot of different ways to do it, but you want all the relationships that the LLC has to be in writing, and then the LLC is the one that agrees to it. Now, I get the LLC isn't a human and can't sign things. So when you sign the document on behalf of the LLC, this is a common thing that happens, is especially with very small businesses, is that they'll still sign the documents in their own name. And you want to sign it as the member of the LLC or the CEO or president or whatever. I don't know. It doesn't really matter. Give yourself a title and you sign it as that title for the LLC. And then that way the LLC is making the agreement and you're not the one making the agreement. Number 5 is not closing the LLC, not formally shutting it down when you're no longer doing it. Very common thing to do is the business didn't ever launch, or maybe you ran it for a while and it didn't work, whatever, and you're not doing it anymore, and then people just don't do anything about that. And then this thing is just floating out there. And you need to shut it down for a number of reasons. One of the reasons is because those bills are going to keep piling up. You're supposed to keep filing taxes and doing your annual filings, and now there's a penalty and all this stuff, and you're going to have to clean up that mess. And you don't have to clean up a mess, just not have the mess. That's better, to just not have the mess. And then also, you don't want to accidentally have the LLC take on other liabilities. And then you don't want to accidentally be on the hook for things because you took money out. So one of the things that when you shut down an LLC, how it works is that the LLC is supposed to pay off all of its debts and all of its liabilities before it pays you out any money that's left in the checking account, you as the owners. Well, that means you got to clean everything up. You have to file the last tax returns, you have to do all the last filings, all that has to be done, completely shut down before any money can come out to you. Otherwise, they can come get the money from you to pay for all that stuff, and that's a big mess. And you don't want that. So if you get to the point in your business where you're no longer going to have this business, you're no longer going to have this LLC, you need to formally shut it down, to terminate it, to cancel it, whatever it's called in your state, so that it no longer exists, and all those loops are closed off and you don't have to worry about your LLC anymore. Again, this is attorney Elizabeth Potts Weinstein. If you have any questions about what we talked about today, you feel free to leave them in the comments below, and I'll try to point you in the right direction. Thumbs up if you found this video helpful. Subscribe for more videos like this. And if you have other questions or would like to connect further, you can join the free Discord or you can sign up for the Patreon. Links are below. Thanks a lot for watching. Bye-bye.